Somewhere around your 73rd birthday, the government starts reaching into your retirement account and pulling money out, whether you need it or not. It's called a required minimum distribution, an RMD, and every video you've seen says the same calming thing. Just take the minimum, pay the tax, you're fine. Here's the honest check on that advice. The withdrawal itself is the small part. The RMD isn't the bill, it's the trigger. And what it sets off, the same year and 2 years later, is a wave of taxes on money that has nothing to do with the withdrawal. Most people optimize the one number they can see and walk straight into the 3 they can't. So stay with me to the end, because the 3 perfectly legal moves that diffuse this whole thing are worth more than the tax itself. And the last one is the easiest to do. Here's the claim almost nobody questions, because it sounds so boring. You have to take a minimum withdrawal, so just take it. True, as far as it goes. But that withdrawal is income. And in the tax code, income doesn't sit quietly in its own box. The moment your RMD lands on your return, it reprices 3 other things at once. How much of your Social Security gets taxed, what you'll pay for Medicare 2 years from now, and which tax bracket your last dollars fall into. That chain has a name among planners, the tax torpedo, and the RMD is what fires it. So here's the mental model, and it's 2 pieces. Piece 1 is the trigger. That's the RMD itself, a timer that starts at 73 or 75 depending on your birth year, and once it starts, it forces a chunk of income out of your traditional IRA or 401k every single year on a schedule the IRS sets, whether your budget wanted that money or not. Piece 2 is the torpedo. That's what the trigger sets off downstream, a 3-part tax wave that hits money you didn't withdraw. More of your Social Security becomes taxable. Your Medicare premium jumps 2 years later, so you don't even connect it. And the withdrawal stacks on top of your other income and shoves your last dollars into a higher bracket. 1 pull of the trigger, 3 explosions. So here's the one line I want you to hold for the next 20 minutes, and I'll keep coming back to it. The RMD isn't the bill, it's the trigger. Let me put 3 real people on this. Same age, same account balance, 3 completely different outcomes. And by the end, you'll know which one you are. First, Barbara. She's 73, she lost her husband last year, and she does exactly what the internet told her. Takes the minimum, pays the income tax on it, done. She's sure she's handled it. Hold on to the fact that she's newly widowed. It turns out to matter far more than she knows. Second, Ed. Same balance as Barbara, but Ed spent his 60s quietly moving money out of his traditional account. So when the trigger finally fires, his RMD comes in smaller and softer. And third, a cautionary one. Call him Walt, who heard he could delay his first RMD to save himself a year, did it, and then took 2 of them in a single calendar year without realizing what that stack would do to him. Same rule for all 3. Barbara gets blindsided, Walt gets hurt, Ed barely feels it. The only difference is whether they saw the torpedo coming. I'm Jeffrey, by the way. I've spent years reading these IRS rules line by line, and I walked my own parents through this exact decision, so I'll keep it plain. This channel takes the retirement rule everyone repeats and checks it against what the agency actually wrote, receipt on screen. So let's check this one. Start with the trigger itself, because the age trips people up. Thanks to a 2022 law called Secure 2.0, your RMDs begin at 73 if you were born between 1951 and 1959. And at 75 if you were born in 1960 or later. So pause this video right now and find your birth year, because there is no single universal RMD age anymore, no matter how confidently a headline states one. And there's a trap baked into the first year. The IRS lets you delay your very first RMD to April 1st of the following year. Sounds like a free pass. It isn't, because if you delay it, you then have to take your second RMD by December 31 of that same year. 2 required withdrawals, 1 calendar year, both taxed together. That's Walt's whole mistake, and we'll watch it hit him later. And 2 more timing rules quietly trip people here. First, the still working exception. If you're genuinely still employed at 73 and you don't own more than 5% of the company, you can delay the RMDs from that current employer's plan until you actually retire. But, and this is the part people miss, that break does not cover your IRAs or any old employer's 401k. So those still have to come out on schedule. Second, the aggregation rule, which sounds boring and costs people real penalties. You're allowed to add up the required amounts across all your traditional IRAs and take the whole total out of just one of them, in any mix you like. But you cannot do that with 401ks. Each 401k has to pay its own RMD out of its own plan. People with a couple of old 401ks assume they can cover everything from one account the way they do with IRAs, miss one, and get a penalty on a rule almost nobody bothers to explain. Quick word on the penalty, because the old number scared everyone. It used to be that if you missed an RMD, the IRS took 50% of what you should have withdrawn. 50. Secure 2.0, cut that to 25% and down to 10% if you catch it and fix it quickly. So the penalty got a lot less brutal. But don't let that be your takeaway, because the penalty was never the real cost here. You're going to take the withdrawal. Almost everyone does. The money that quietly leaves your pocket isn't the penalty, it's the torpedo. So let's walk through the 3 explosions, one at a time. Explosion 1. Your Social Security. Here's the piece that ambushes people. Whether your Social Security benefit is taxable depends on something called combined income, roughly your other income plus half your benefit. And an RMD is other income. So when the trigger fires and drops that withdrawal onto your return, it lifts your combined income, and that drags more of your Social Security into the taxable column. Up to 85% of your benefit can become taxable. Read that again. The withdrawal doesn't just get taxed itself. It reaches over and makes a chunk of your Social Security, money you didn't touch, taxable too. That's the torpedo planners named, because for a stretch of income, every extra dollar of RMD can also make 50 to 85 cents of your Social Security taxable, so your real marginal rate spikes far above your bracket. Here's what makes it a torpedo and not just a tax. For that stretch of income, each extra $1,000 of RMD doesn't only get taxed itself, it simultaneously flips several hundred more dollars of Social Security into the taxable column, so you can sit in a 12% bracket on paper and pay an effective rate closer to 22% on that RMD dollar. Same tax code, hidden rate. It's a submerged spike you never see on the bracket table, which is exactly why it catches careful people like Barbara. And I want to say this now, before you spiral, because the rest of this is going to sound like nothing but bad news for a few minutes. Every single hit I'm about to walk you through can be softened. There are 3 legal ways to take the sting out of this torpedo, and I'll hand you all 3, but you have to see how it fires first, so you know what you're diffusing. Explosion 2. And this one is sneaky because it arrives with a 2-year delay, so almost nobody connects it to the RMD that caused it. Medicare sets your premium using your income from 2 years ago. So the income on this year's tax return, including your RMD, decides what you'll pay for Medicare Part B and Part D 2 years from now. If that RMD pushes your income over one of Medicare's lines, you get hit with a surcharge called IRMAA, and it's a cliff, $1 over the line, and you owe the whole higher tier straight out of your Social Security check. The standard Part B premium is about $203 a month right now. IRMAA stacks on top of that. And here's the cruelty of the timing. You take a big RMD at 73, feel fine, and then at 75, a letter shows up raising your Medicare premium, and you've completely forgotten why. And because IRMAA is a cliff, not a ramp, the damage is lumpy and a little cruel. A retiree sitting just a few $100s under a tier who takes a large RMD can cross the line and owe the entire next tier's surcharge for the whole year, for being a single dollar over. There's no partial credit and no easing in. So near one of those lines, the size and timing of your RMD matters far more than the withdrawal itself ever suggests. Explosion 3 is the simplest and the one people do expect, but they underestimate it. Your RMD doesn't get its own private tax rate. It stacks on top of all your other income for the year, your pension, your other withdrawals, your part-time work, so it fills up your current bracket and then spills the last dollars into the next one up. For a lot of retirees, the RMD is the single biggest piece of income they don't control, and because it grows as your account grows and your life expectancy shortens, it tends to get bigger every year, pushing more of your income up the ladder over time. And here's the part that should worry couples the most, because it ties to something we covered last time. Brackets and thresholds for a single filer are far lower than for a couple. So the day one spouse dies, the survivor files single, and that very same RMD income now torpedoes them harder, crossing the Social Security and IRMAA lines that a joint return kept it under. The withdrawal didn't change. The rules around it got half as generous overnight. So that's the full torpedo. The withdrawal is taxed. It makes your Social Security taxable. It sets your Medicare premium 2 years out. And it creeps your bracket. And hits a survivor even harder. Several hits from one required move, and the advice online only warned you about the first one. Let me put rough dollars on it with Barbara, and I'll flag these as illustrative, round numbers to show the shape, not your exact bill. Her first RMD is around $40,000. The advice she followed says, that's income. You'll pay your bracket on it, budget for that. So she budgets for the tax on $40,000 and feels prepared. What the advice didn't tell her, that $40,000 also flipped a big share of her Social Security into the taxable column. So her actual bill is noticeably bigger than the bracket math suggested. And here's where losing her husband quietly doubles the damage. Now that she files as a single person, all those lines we talked about sit at roughly half the level a married couple gets. So the very same $40,000 withdrawal that a couple could have absorbed sails her right over the Social Security threshold and over an IRMAA line, and 2 years later, her Medicare premium climbs. She did everything the video told her to do. She just didn't know the withdrawal had 3 other jobs, and that widowhood had moved all the goalposts closer. If you just got here, here's the whole thing in 30 seconds. 1. At 73 or 75, the government forces income out of your traditional retirement account. That's the trigger, and you can't skip it. 2. That withdrawal is income, so it fires a torpedo. It makes up to 85% of your Social Security taxable. It sets your Medicare premium 2 years later, and it creeps your bracket. 3. The advice online only warns you about the withdrawal's own tax and misses the other 3 hits entirely. The RMD isn't the bill, it's the trigger. Now here's the good news, because there are real, legal ways to soften the torpedo, and the people who use them barely feel it. Here's where this turns from a warning into a plan. You cannot skip an RMD. It's a published rule. The tax was deferred for decades and now it's due. But you have real control over how hard the torpedo hits, and there are 3 levers, all legal, all in the IRS's own rules. None of them are secrets. They're just things nobody tells you until you're already 73, and it's harder to use them. So let me give you all 3, and then you'll see exactly how Ed used them. Lever 1 is the quiet favorite, a qualified charitable distribution, a QCD. If you're 70 and a half or older and you give to charity anyway, you can send money straight from your IRA to the charity. And here's the magic. It counts toward your RMD, but it never lands in your income at all. It skips your AGI entirely. That's the whole game, because remember, it's your income that fires the torpedo. Money that never enters your income can't tax your Social Security and can't push you over an IRMAA line. So if you were giving anyway, routing it through a QCD satisfies part of the RMD and diffuses part of the torpedo in one move, up to around $108,000 a year. One catch that ruins it if you get it wrong. The money has to travel directly from your IRA custodian to the charity. If it lands in your own account first, even for a day, it counts as a taxable withdrawal and the whole exclusion is gone. Lever 2 is the most powerful, but it has a clock on it. You mostly use it before 73. Every dollar you move out of your traditional account in your 60s, usually by converting it to a Roth in a low-income year, is a dollar that will never be part of a future RMD, because Roth accounts have no required minimum distribution for the original owner. So Ed spent his 60s, in years when his income was low, converting measured amounts to Roth and paying tax on his own terms, at his own bracket, on his own schedule. By the time the trigger fired at 73, his traditional balance was smaller, so his RMD was smaller, so the torpedo had less to work with. We did a whole video on the right and wrong way to do those conversions. I'll link it. But the headline is, the cheapest way to soften an RMD is to make the account it comes from smaller before the timer ever starts. Lever 3 is the simplest, and it's the one Walt missed. When you turn 73, the IRS offers to let you delay your very first RMD to April the 1st of the next year. Do not take that offer without doing the math, because if you delay, you take 2 RMDs in the next calendar year, the delayed first one and that year's, and they stack on the same return. Double the income in 1 year means a double-strength torpedo, more Social Security taxed, a bigger IRMAA hit, more bracket creep all at once. For most people, the smarter move is to take your first RMD in the year you actually turn 73, so you never let 2 of them land together. 1 a year, spread out, is a gentler ride than 2 crammed into 1. So watch Ed. Same starting balance as Barbara. But Ed didn't wait. All through his 60s, in the leaner income years after he stopped working, he converted measured chunks of his traditional account to Roth, paying the tax on his own terms instead of the IRS's. So at 73, his traditional balance was meaningfully smaller and his RMD came in lower. And the slice of that RMD he doesn't need to live on? He sends it straight to his church as a QCD, so it satisfies the requirement without ever touching his income. Result: less of his Social Security gets taxed. His MAGI stays under the IRMAA lines, and his bracket barely moves. Same balance as Barbara, a completely different tax life, because Ed shrank the trigger years ago and routed what's left around his income. He didn't beat the IRS, and he didn't dodge a dollar he legally owed. He just read the rules while he still had the levers to pull. Barbara had the same options once. Nobody told her in time. And one quick cautionary tale: Walt, because his is the avoidable one. Walt turned 73, saw the option to delay his first RMD to April, and thought, great, I'll push it and save myself a year of tax. So he delayed. And the next year he took the delayed RMD and that year's RMD, 2 full withdrawals, both landing on one tax return. His RMD runs around $40,000 a year, so by pushing the first one, he stacked roughly $81,000 of forced income onto a single return, instead of letting $40,000 sit in each of 2 years, where the lower total might have stayed under the lines. That one stacked pile did everything at once: dragged the maximum share of his Social Security into tax, launched his MAGI clean over an IRMAA tier so his Medicare jumped 2 years out, and shoved a slug of income into a higher bracket. He didn't skip the tax. You never skip the tax. He just concentrated a whole torpedo into 1 year for nothing. Take the first one on time, and that same money spread over 2 years would have cost him meaningfully less. So who does this change the decision for? Be honest about which seat you're in. If you have a large traditional IRA or 401k and you're in your 60s, this is your window. The Roth conversion lever is wide open now, and it slams shut as the trigger nears. If you're already taking RMDs and you give to charity, the QCD is the single easiest diffuse you have, and most people who qualify have never used it. If your income is modest and your RMD is small, honestly, the torpedo may barely touch you, and that's fine. Not every retiree needs to worry about this. And if you're the higher earner in a couple, remember your RMD stacks with everything else, and your MAGI drives both of your Medicare premiums, so your withdrawal is really... So what's the verdict on, at 73, you just take the minimum, no big deal? Misleading. And it's the kind of wrong that cost you quietly, in 3 places you weren't watching. It's not that the rule is unfair. You deferred that tax for decades and now it's due, and that's the deal you signed up for. The misleading part is the framing. Just take the minimum treats the RMD as one small isolated line, when it's the trigger that fires a torpedo at your Social Security, your Medicare premium, and your bracket, all from money you didn't even want to withdraw. The people who get hurt aren't careless. They did exactly what the video told them. They just optimized the one number they could see and never knew the withdrawal had 3 other jobs. And let me be fair, because I don't want anyone panicking or over-engineering a small account. If your traditional balance is modest, your RMD is small, and your income is low, then honestly, take the minimum, pay the tax, and go enjoy your retirement. The torpedo needs a big enough withdrawal to do real damage, and plenty of people simply don't have one. Don't pay an advisor to solve a problem you don't have. This video is for the person with a serious traditional balance, or the person in their 60s who still has time to shrink it, or the couple watching their MAGI dance near an IRMAA line. If that's not you, the honest answer is, relax, and just don't miss the deadline. Here's what to actually do, and it's a short list. Find your birth year and your RMD age, 73 or 75, so you know when the trigger starts. If you're already taking RMDs and you give to charity, ask your IRA custodian about doing it as a QCD this year, before you take the rest of the withdrawal. If you're in your 60s with a big traditional account, run the numbers on a Roth conversion in a low-income year, quietly, on your terms, before the timer starts. And if you're turning 73, take your first RMD on time. Don't defer it into a double. 1 login to your account, 1 look at your birth year, 1 honest question about charitable giving, and 1 conversation about conversions if you've still got the runway. And the part I always do because you've been sold enough fear this year, 3 things not to panic about. 1. This is not the government stealing your retirement. You got a tax deduction on this money going in and decades of tax-free growth. The RMD is simply the tax finally coming due, exactly as designed. 2. The penalty is not the monster it was. It's 25% now, 10 if you fix a slip quickly, so a single honest mistake is not a catastrophe. And 3. You do not need to become a tax expert. You need your birth year, one question about charitable giving, and, if you're still in your 60s, one honest look at conversions. That's it. One honest note. This is educational only. It's not financial advice, and it's not personal tax advice. Your birth year, your balance, your other income, and your charitable intent all change this answer, and IRMAA lines and thresholds shift over time. Run your own numbers or take them to a tax professional who can see your whole return. What I can tell you is what's written down. The RMD isn't the bill, it's the trigger, and the torpedo hits 3 things you weren't watching. Don't just count the withdrawal, count what it sets off. If this was useful, send it to someone who's turning 73 this year. It'll save them more than it saves me. Next time, the Social Security fix Congress keeps promising, is any of it real, and what would it actually do to your check? Check the rule, not the slogan. I'll see you then.